In this presentation, we'll take a look at the question of, are you self-employed? Seems like it would be a fairly straightforward question, but it's not always a straightforward question. There's a question as to what is the line as to when someone is an employee versus someone being self-employed. There's also a question as to when is there a line between something being a hobby and something being a self-employed business. We're going to be focusing in up here on the income section, but remember, whenever we think about self-employment, we're thinking about the possibility of a Schedule C, the Schedule C having both income and deductions, expenses on them, that then roll forward to the net income to the first page of the 1040, represented by this formula, and then would be recorded in the income section of the formula. When we're thinking about the actual 1040, there were various lines that could be affected, but we're typically thinking about the other income, the main section that would be affected by self-employment income, which would be supported by the Schedule 1, and that would be supported by the Schedule C. So are you self-employed? You are a self-employed person if you carry on a trade or business as a sole proprietor or an independent contractor. So then what is a trade or business? Trade or business? A trade or business generally is an activity carried on to make a profit. So it would be just like what you would think it would be. Are you self-employed? Well, are you carrying on a business with the intent of making a profit? And that intent of making a profit is important because that can be a distinguishing factor between a hobby and a for-profit trade or business. The facts and circumstances of each case determine whether or not an activity is a trade or business. You do not need to actually make a profit to be a trade or business as long as you have a profit motive. So notice that's going to be really important here because the IRS is going to be most concerned with losses. When you have a loss, if you had a loss on a trade or business, typically that's okay, and you actually get to write that off against the W-2 income possibly. And the IRS is going to be skeptical of that. So the IRS, you got to remember, just keep your mind that every time there's a loss, the IRS is skeptical of that because they're thinking that possibly the loss could then be taken against other income, and therefore they don't, they're going to be on the lookout for losses to be whether they're valid or not. So the fact that you have a loss, meaning deductions greater than the income for the business, expenses greater than the income, doesn't necessarily mean it wasn't a business as long as your intention was for a profit motive. Now, if your intention was a hobby that actually it resulted in a loss and a little bit of income, then the IRS would typically think that, well, this isn't in a trade or business, it's a hobby, and therefore you could be limited to something like not being able to take the loss against other income. So you need to make an ongoing efforts to further the interest of the business. Sole proprietorship. A sole proprietorship is someone who owns an unincorporated business by himself or herself. You also are a sole proprietor for income tax purposes if you are an individual and the sole member of a domestic limited liability company, unless you elect to have the LLC treated as a corporation. So note that basically if you start doing something for profit, you are in essence a sole proprietor for tax purposes. And you might think when you start a business, when you start doing something for profit, you may think that there's all these things that you have to do, like to get a special number, like an EIN number, or possibly to get a business license or sales tax identification, or these types of things. Note that for the IRS, for federal income taxes, that's not true. You don't need an EIN number, even though that's a federal number. The EIN number is going to be something that you're going to be needing if you have employees. It's also something that you may want to have because other people may ask for your identification number as a business. And if you don't have an EIN number, you have to give them your social security number in those circumstances. So typically you would want the EIN number even if you don't have employees on the federal side. The other local taxes are typically going to be state and local information, and you may need to be in compliance, of course, with those types of items. But the IRS, and you can think of this from the IRS standpoint, of course, if they see you making money, then they want their share of it, right? There's no other rule that needs to be passed there. If you have a business and you're generating revenue, your silent partner, the IRS, is going to want their share of it. There's no kind of limiting factor where they're going to say, oh, well, you didn't get your business license, so you don't have to pay us our share of your money, right? They're going to, so there's no other, if you have a business and you start making money and you're profitable, then it's most likely a business. Even if you're not profitable, it may be a business, but the IRS is hoping you're profitable. if you're making money and it's profitable, then you're basically a sole proprietorship unless you register as some other kind of business entity like a corporation or an S corporation or something like that. Independent contractor. People such as doctors, dentists, veterinarians, lawyers, accountants, contractors, subcontractors, public stenographers, and auctioneers who are in the independent trade, business, or profession in which they offer their services to the general public generally are independent contractors. However, whether they are independent contractors or employees depends on the facts in each case. The general rule is that an individual is an independent contractor if the person paying for the work has the right to control or to direct only the result of the work and not how it will be done. So this is going to be important if you're considering a situation whether or not, and these are often types of industries where there's going to be a question as to whether you are an independent contractor or W-2 employee. And usually it comes to, and there's not a choice between these two things per se. The IRS would like to draw a line. The line isn't as clear as you would think in every instance. There could be instances where you may be able to be a contractor or a W-2 employee, but the IRS wants to make it as concrete as possible to say when someone is an employee and when someone is a contractor. In other words, if you had a 9 to 5 job, you couldn't simply go to your employer and say, hey, let's just reorganize this as if I'm a contractor now and not an employee, but I'm still going to come here from 9 to 5 and work as an employee. You can't do that because the employer is you're clearly in the realm of being an employee there. You have a set time and there's a set circumstance on how to do the work, not simply the outcome of the work. Now, if you're a contractor, then oftentimes when you work for someone, even if you work for one client a lot of the time, they're usually focused on the outcome of the work, and therefore when you show up, the times that you're going to show up, the tools that you have might be yours. So the more independence in terms of how you get to the end result that you had a contract to do with somebody else, the more likely that you then would qualify as an independent contractor. Now, whether you want to be an independent contractor or not depends. There's pros and cons on both sides. Like we said, if you're an independent contractor, you may be able to deduct more of the expenses for things like tools and resources you use that you may not be able to deduct even if you pay for them as a W-2 employee. However, we saw that the self-employment tax is also a significant factor, and it's typically higher. There's a higher rate because you're the employer and employee portion. So if you're in that kind of circumstance where you're debating as to whether you want to be a contractor that is self-employed or to work as someone that's employed, you got to weigh those two sides, those pros and cons. The earnings of a person who is working as an independent contractor are subject to self-employment tax. So that's a key point, self-employment tax. That's kind of like the wages or the Social Security and Medicare that would be taken out if you're a W-2 employee. However, now you're basically paying more because the IRS considers you both the employee and employer and calculates the self-employment tax on that, as we saw when we went over the tax return for the individual tax return 1040 in a prior presentation. Exception, community income. If you and your spouse wholly own an unincorporated business as community property under a community property laws of a state, foreign country, or U.S. possession, you can treat the business either as a sole proprietorship or partnership. So note we said that a sole proprietorship is one individual. Well, what if you're married in a community property state and you want to check on the state to see if you're in a community property state? Well, then in those circumstances, you may be able to, rather than have a partnership, which you typically would if you had two individuals, because you're one individual and filing the one return, possibly be able to report on the Schedule C. States with community property laws include Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. A change in your reporting position will be treated as a conversion of the entity. See Publication 555 for more information about community property laws. Exception, qualified joint venture. If you and your spouse each materially participate as the only member of a jointly owned and operated business, as you file a joint return for your tax year, you can make a joint election to be treated as a qualified joint venture instead of a partnership for the tax year. Making this election will allow you to avoid the complexity of Form 1065. So again, if you're married, then you might want to avoid filing a 1065 because it's another step. You have to file the form 1065, which then flows through to the 1040, which can be much more complicated in terms of just processing the return and paying for tax preparation. So it would be easier if married and have two people that are both owners of the business to be able to report on the Schedule C, kind of like a sole proprietor, even though there's two people involved. But still give each spouse credit for Social Security earnings on which retirement benefits are based. Note that when you're talking about the Schedule C, when you're paying into the self-employment tax, you're paying into Social Security and Medicare. So it would be nice then to be able to say that that payment we can apply then to both spouses, who would then get credit because that would be beneficial at the point of retirement, because the retirement distributions from the Social Security fund are based in part on the contributions to it. So if you have a Schedule C for a married couple and it's only under one of the married couple's Social Security, then all of the payments that they have to make to Social Security and Medicare basically go to the benefit of that one individual. However, if you're able to split them up between the two, that could be beneficial for the retirement point when the Social Security benefits would then be distributed. For an explanation of marital participation, see the instructions for Schedule C, line G.